And I had been investing in real estate previously, not even thinking of the strategies that I was doing.
Okay.
November 2019, I owned one property.
Okay.
And then by, I think by mid 2021, I owned like 15. You see a lot of people lose it all when they have a lot of lifestyle creep. Maybe they hit becoming a multimillionaire, and then they're going out and buying the stuff they don't need, the luxury cars.
News about BlackRock and Bill Gates buying like all of these big, huge, multi-billion-dollar businesses buying a lot of like residential real estate. Like, what do you think of that? Would you recommend getting your real estate license if you want to be like passively investing in real estate? Welcome to episode 4 of the Millionaire's Mic. I'm here with James Lascara, who is a huge real estate investor, just a wonderful human being. And so I'm really excited to like dive into all of the cool real estate and just general like entrepreneurship, business knowledge that you have. So without further ado, I'll let you kind of kick it off. Give me a little bit about like who is James?
Yeah, thank you so much for having me on. I feel humbled just to be asked to be on your podcast. I think you're doing a great thing by taking a look at the entrepreneurship space in Central Florida. I think there's a lot of lessons to be gleaned from that. So what would you like to know about me? Just background, what led me to this?
Yeah, let's kick it off. Like, how did you get into real estate? What's your background?
Yeah, absolutely. So I went to college, obviously after high school, went to the Naval Academy and studied ocean engineering. So I'm very analytical. I like numbers and processes and systems and things like that. Immediately graduated college and entered the Navy, and that led me to Virginia Beach. In the process of transferring from Virginia Beach down to Tampa, I rented out a property in Virginia Beach, or attempted to rent out a property, and had a really terrible time with it. Just had a property manager that didn't perform well, fired them and did a different property manager. That wasn't much better. And I was finding myself in the midst of all this hardship in real estate investing. And I realized it was the result of poor preparation. And so that inspired me to then take action to learn more, because if you don't do the preparation or the education, what result are you really expecting to get? Probably not a great one. And so I had disjointed expectations from what I hoped to get versus what I got once I started learning a lot more about real estate investing. This was early 2020. I just put my foot and stomped on the gas pedal and really started buying up single family homes to buy and hold as rentals. Real simple strategy. Closed on 6 places in 8 months. So I just kept buying them.
Whoa.
Yeah. it was all I was doing. I was just analyzing rentals and just kept buying them, making offers. And so then that was the catalyst that I guess really started the real estate investing across a number of different strategy. But first it started with buy and hold rentals.
Okay.
And I had been investing in real estate previously, not even thinking of the strategies that I was doing. For example, house hacking. I had been doing that since I bought my first house, just because I thought it made sense. Like I have more rooms than I need. Why not offset my mortgage with having a roommate? So I've been doing that, and I had been doing some private money lending to friends that they were real estate investing, like in flips. So I've been doing it, just not really leaning into learning more about it until 2020.
Got it. Well, what was, I guess, that first step to you being like, I think I want to buy my first property? Like, was it just, I think this is what I should do because that's what I hear people doing?
Yeah.
Or like, did you already have some kind of real estate interest that you were like, why not start here? Like, what did that look like before?
I just realized, this was 2014 in Virginia Beach. So I just realized, well, I'm paying whatever the cost was, $1,000 in rent. I could pay double that, $2,000 for my mortgage, let's say, but then I'm not spending it on somebody else's mortgage. Then I'm putting money, and I'm putting money into my own mortgage, which gradually goes down over time. But also I can make decisions about this property. I can choose to get a dog, or I can put up a fence, or I can paint a different color without having to ask somebody else's permission. So I also remember thinking at the time, I was, I think 26 at the time. I was like, this is what adults do. So
Right.
Yeah.
Okay. Yeah. Because I'm always curious, because some people are like, oh, well, I thought that's what I needed to do, or like, oh, I had some money. So it's always, or I wanted to, get started in investing. So why not bite the bullet on my first, place to live in? So that makes total sense. And then how did you go? Because I know you said before you started kind of doing a deep dive into like proper real estate investing, you already had kind of acquired other properties before, and you were saying like it was like the preparation that you like didn't have, right? Like you already had, you were acquiring a few homes beforehand.
Not before 2020. So November 2019, I owned one property.
Okay.
And then by I think by mid 2021, I owned like 15.
Wow.
So in the course of in the course of a year and a half, I just really took all that, really like a lesson learned in pain, and turned that into fuel to ignite my curiosity and the drive to educate myself, which I did to a very competent extent. And then that's what led me to the results, because then I just saw deals everywhere.
Yeah.
Once I learned how to really do it right.
So did you like sit down and go, I need to learn everything about real estate investing first before buying? Or were you just like, I'm just going to kind of acquire and learn as I go?
No. So, as we talk over the next hour, I think this will become evident, but my strategy is kind of like the following. Go now, learn what you can to mitigate the risk before you take that very first step. Do not learn everything. By the time you learn everything, the opportunities will have passed you by.
Yeah.
And then use shortfalls or missteps or hardships along the way to make yourself better. That's going to get you way further in your journey than thinking you have to know everything before starting. I see so many people that do that, and it's wrong.
Yeah.
It's wrong. Here's another one. People are always, especially when they first start in real estate, they're always looking for the home run. And you're gonna see a home run 1 out of 100, but you'll probably also see 50 base hits. So I'm always a big believer that a base hit that you can hit today or this week or whatever is way better done consistently and repeatedly than waiting for that home run that you hit once every 2 years. It'll make you way more successful over time.
Yeah.
So.
No, I love that perspective, because so many people try to, like, you go analysis paralysis. Oh, this person did this, that, and you try to get it perfect. And I'm the same way. I learn by doing. So I'm like, I'd rather kind of obviously don't make a stupid mistake, kind of mitigate as much as you can ahead of time, but then learn as you go once you kind of bite the bullet and jump in.
Yeah, absolutely. Well, humans live, like a lot of people live based on fear.
Yeah.
Their fear drives them. And whether you want to admit it or not, a lot of us are similar to that. So it takes a degree, I guess, of courage or really initiative to have that fear do it anyway.
Yeah. And why did you choose to like go down the rabbit hole of real estate? Like, why not, choose other business ventures? Why did you choose that?
A couple things. Once you realize some fundamentals about real estate, you realize that it's the cheat code. It's the cheat code to becoming a millionaire pretty easily. It's the cheat. I mean, that's the name of your podcast, right?
Yeah.
It's the cheat code to paying less taxes, because the government is going to incentivize you for you to do what they want you to do. They want you to buy and own real estate because that's stable.
Right.
They have all these tax advantages. I mean, I just talked in my mastermind group for an hour about 4 of them that I love to use. And so once you start to wrap your head around those tax savings benefits, then you're like, why would I spend my time trading my time for money when I can trade my money for money via real estate?
Right.
Yeah.
Beautiful way to say that, because everyone is always like, oh yeah, like real estate's the best way to, and obviously, like you said, it's the fastest way to become a millionaire. Because I know when we chatted, it was like, you've been investing, I guess, for over the past 4 years now, almost 4 years now.
Yeah, like hardcore, I would say. Yeah.
But like it's already gotten you there. So I'm like, to get that kind of return in a relatively short time period is pretty impressive.
Yeah, I appreciate that. I mean, I've always lived below my means. I'm a big believer in that. You see a lot of people lose it all when they have a lot of lifestyle creep. Maybe they hit becoming a multimillionaire, and then they're going out and buying the stuff they don't need, the luxury cars. And I'm not against that. It's not for me, but that's how you get yourself in a bad situation pretty quickly, because you're no longer living for 60 grand a year. You're living for 200 grand a year. And that's, that's less money in assets that can pay you. There's one strategy I believe in really wholeheartedly. That's the easiest way to become a millionaire. And that's house hacking. Yeah, for sure. For sure. There's a lot of ways to become a millionaire, but I think it's the easiest.
Yeah. And I'm familiar with house hacking, but just for anybody who's listening, do you want to just give a quick spiel of what house hacking is?
Yeah. and it's not for everybody. I'm not trying to shame people that don't want a house hack. I think people who are like, no, I could never do it. I think you're leaving a lot of opportunity on the table. And I think that you probably favor your comfort more than you favor long-term financial freedom.
Right.
But if you want comfort now in exchange for not owning a private jet in 10 years, like, okay, I get it. I'm not saying house hacking will give you a private jet.
Right.
But so so what is house hacking? House hacking is when you either buy a single family home and you rent out the extra rooms that are in that single family home. So you got to buy it a little bigger than you need. Or you buy a multifamily up to a 4-unit because that's residential property, and you rent out the extra units. So both are house hacking, but the idea is use somebody else who's cohabitating that space either way, and use that to offset the expenses, the mortgage, and whatever you have to cover on the property. If you do it right, you can live better than free.
Yeah. That's been like a strategy that I've been like, I'm going to be doing that essentially. Because it's the best way to kind of be like, I can at least live pretty decently and not have to pay, you know, the full amount of like what the mortgage is. And then I'm building my equity and, you know, you have the funds to use, you know, how you want. So I love that. And then I guess talking about how you got into like when you decided you wanted to go into like this like hardcore real estate investing path, like where did you go to like like just become a sponge and just learn? Where did like were there people? Was there, you know, a networking group? Was it just Googling? What did that look like for you?
A little bit of everything. I don't love to learn things that are technical in nature by reading books. I prefer to learn it by people who have been there before or maybe videos. So it was a combination between YouTube University, talking to friends who owned rentals, and then a little bit of like forums on the internet, but that didn't prove to be super helpful for me. So a combination of those. And what I did is I set a goal to analyze a certain number of rental properties every single day. The cool thing is rentals work like any property out there, any property, I don't care what it is. If it's a residential property, any property can work as a rental. It just depends on what you acquire it for, right? Like even these houses on Bayshore blocks away that are $5 million, like that could work as a rental. You might just have to pay $2 million for it, right? Nobody's going to do that, obviously. So what I did is I said, all right, James, every day analyze 5 properties or 10 properties or whatever it was, and come up with the price based on your target returns for what you'd have to pay for this property for it to work and hit the metrics that you would want. And so on some, once I realized certain neighborhoods in Tampa and certain areas where I thought buying would be a long-term advantage, then I would just make offers when it was close to the listing price. Yeah.
And how do you assess this neighborhood is good or this neighborhood is going to appreciate?
It's all personal preference. So at the time, I would say my goals at the time were way different than my goals now. So I valued looking at the internal rate of return or the average annualized return, very similar metrics, and the cash on cash return that you're getting, which is basically the cash flow above your mortgage and any expenses that you got to put back into the property. So I would look at something that offered like a 6 to 10% cash on cash return. I don't care about that anymore at all. But that got me going with my first 4 properties, and I learned a lot in doing that. Really what I learned is like long-term equity is a way better thing to strive for and also more risky than just hitting like a 10% cash on cash return.
Right. Yeah. I guess it's kind of, you could get a high return, but then, you know, everything can kind of come crashing down versus, you know, long-term gain and those small gains over time that are going to, you know, get you there too. That's what I guess everyone has a different style of investing, I guess, because I feel like you hear a bunch of different, you know, real estate investors, and some people are like, never buy single family homes, only buy multi-unit, or like, you know, there's a whole range of things. So it's interesting to hear like, you know, your perspective. And I guess on that, like what type of homes do you like prioritize buying? I know you said you bought like a few single family, but
I don't buy residential rentals anymore.
Okay.
Yeah, I don't it's not scalable in the strategies that I want to grow in my business, and so I don't buy residential rentals anymore.
Interesting.
Like I don't buy residential single family homes for the sole purpose of them being a rental.
Okay.
We can talk about that a little bit.
What do you mean by that?
If they end up becoming a rental because I lived in them and I'm planning on using a few different combinations of tax strategies and I need to rent them out for 2 or 3 years, that's fine. But I don't go out these days and say, hey, I'm going to buy that house as a rental. Day 1 of closing, it's only going to be a rental and I'm not going to live in it. I don't do that anymore because it's not it's not the strategy that I like to use in my business to scale.
Interesting.
Yeah. Yeah.
So
Larger.
So what are you buying?
Larger. Yeah. So I have 4 real estate businesses.
Okay.
So I'm an agent. The reason I got my license was just so I could have better access to my own deals.
Mm-hmm.
Now that's become a different revenue stream because I realized I have a lot of really niche, unique competency in the investment space. So now I can work with others who maybe want a house hack and then later turn it into rental because I've done it 5 times. And so agent is a business where I work with clients now too. My development business, so we do ground up, urban infill, residential only right now, development in Tampa, 1 to 4 units. We have 3 projects right now. My rentals, I still own residential rentals. I'm just not acquiring more.
Okay.
Yep. And then capital allocation in larger commercial deals. That's where I'm really focused on for 2024.
Okay. What does that mean?
All right. That's a lot. Yeah, a lot of good words.
What is that 4th one? What is it?
A lot of good words. A lot of big words. So let's say there is an operator that finds a really profitable commercial deal. Well, I'll use a real example. So I'm partnered with a group and they just invested in a property in Jacksonville, North Carolina, near the Marine Corps base at Camp Lejeune. And so they found a value add commercial multifamily property or an apartment complex. And so on something like that, let's say they're buying it overall for $5 million. Well, they're going to leverage that with a commercial loan. So let's say they have to put like 25% down. So that's 1.25 million, right? Well, let's say they also, and these numbers are hypothetical. I don't have them memorized. So let's say for the value add, so they need to go in and renovate all the rooms and optimize the management of the property and just make it nicer because the rents are all below market. So to charge more market rent, you got to make the property overall more amenable to tenants. So let's say to do that, they need $750,000. 1.25 plus 750 is $2 million. So they're going to raise $2 million from investors like myself and people just like me. And so what I do is I invest in those projects and I also share them with my investors so they can get involved in them as well.
Okay.
So growing that arm of my strategies is something I'm really focused on in 2024.
So it's almost like you're owning a piece of someone else's real estate, essentially, right?
Yeah, you actually own an equity. You have
like you own equity in
the business that owns the real estate, which is cool because you get pass-through depreciation benefits as well, which is you get all the tax advantages as if you own it like a single family rental, but it's way more scalable.
Wow.
Yeah.
And then I guess what are like the pros and cons? Because I guess you're not really like managing it in that sense, right? Like it's almost you kind of are getting this passive income, but like I guess what are the pros and cons of like having a situation like that?
Yeah, absolutely. That's a really good question. So everything in life is risky. Not taking action is the biggest, not taking action is the biggest risk of all. So everything is a trade-off, risk versus reward. So the pros of a deal like that, first of all, totally passive, right? Totally passive. That's probably the biggest reason why I love it right now. Second of all, scalability for repeat results. You can get compelling returns on numerous projects all concurrently. That's great.
Yeah.
Third, the returns that you get combined with the tax benefits. Okay, so those are 3 benefits. The downsides I would say is time horizon. So a lot of these deals are 3 years minimum, more likely 5. So going 3 to 7 years on a hold for that project is not unreasonable. Like that happens.
Okay.
And that's expected.
Yeah.
Second one, this is a big one, illiquidity. As a limited partner, there's 2 classes of members. There's general partners and limited partners. There's also different types of limited partners, but for the sake of the podcast, I don't think we should go into that.
Okay.
So as a limited partner, you have no voting rights for when they exit the project.
Okay.
The way the returns are structured are such that general partners benefit the most when they make it really great for the limited partners. So it's in their best interest to really optimize that. But limited partners don't get to vote like, hey, I think we should exit, or hey, I need my money back. I had a life emergency come up.
Yeah.
So a lot of investors I talk with, especially inexperienced ones, if they say, hey, how long does a project like this go? And I respond that it goes 5 years. Then they're like, oh, I don't like that. I would say, great to know this project's not for you.
Right.
Like, I'm not going to sell you on, I'm not going to try to convince you that it is. It's simply not.
Right.
Yeah.
But I mean, I guess, so I guess you said the biggest con is like not, I guess, you don't really have full access to what that return looks like for you. Like you can't be like, hey, I need this money now. Can you sell the property? Like it's not really your...
Yeah, you have access to what the returns are from a reporting standpoint.
Okay.
Like they're sharing all their numbers for revenue and expenses.
Okay.
But I guess to make it simple, you have no control.
Right.
Yeah, you have no control over the outcome.
Right.
Yep. That's why it's important to partner with trusted operators that know what they're doing.
That aren't gonna like go under and be like, we're gonna go bankrupt on this, and we're not doing it anymore. Thanks for your money, but we're done.
Yeah, it's not risk free.
Yeah,
it's not risk free.
Right.
So
okay.
Yeah,
that's an interesting strategy, and I guess it is cool in that sense where it's like, okay, I can give you 50 grand, and in a few years this will be something useful, but I'm not wasting my day to day on day-to-day maintenance that you would if you had like a rental property or something, right?
So I wouldn't, because you used a word there that I would actually challenge. You said wasting. And you're not wasting, but allows you to diversify with other strategies at the same time. Because if I'm doing this one that's super passive and that's giving me long-term competitive returns, well, that freed up some other time where I can use some other money within my portfolio to maybe take a harder look at acquiring, managing, and exiting development deals. Okay. Right? So that's super active sometimes. Okay. That's a game for me. I feel like that's a game where it's like hurry up and wait. Do all these revisions really quick, get it back into permitting, and then wait. Okay, they came back with a response at the city. We do the same thing again and wait. So like right now we had a lot of momentum on our townhome project in North Hyde Park, and then we had a truss engineering issue that we hit. So we hurried up and had a redesign, and now we're just waiting for the manufacturer of the trusses, which will be delivered right around Christmas, and then we'll be go time again. So it's like some hurry up and wait. But, okay. Yeah.
And speaking of development, like how does that even work? Like how do you go from I am owning some real estate now, okay, I'm investing into other properties, to I found a piece of land and now I'm going to put townhomes on it. Yeah. How do you even go about that?
I'll share the whole thing. So it's actually way simpler than it may seem from the outside looking in. So I'm pretty sharp on vision. I'm a big believer in, hey, have a sharp vision, clarify what that is, and then back your goals out of that, then back your goals up into actionable steps that you can be taking each week. I'm a big believer in that. And I tell my mastermind group that same exact information as well, because I've seen how powerful it can be for strategy. Now, here's a real caveat. Your vision will change, right? So what I found was, and this is how my vision changed, I was doing all this rental stuff, was entering into some commercial deals, the syndication space, which was like the commercial or the capital allocation I was talking about. And I was buying a new house every 2 years for tax reasons. Capital gains tax exemption plus house hacking, great tax strategy. So I would buy new construction each time. And at the last one I bought in 2021, I looked and I did the math. I was like, hold on, they bought the land for $250, and their cost to build that, the exact build that I'm buying, it cost them $400 to build it, and $250 plus $400. Let's throw some holding costs in there, $250. That's $700K. Well, they sold to me for $850. So there's some delta in there. So the question is, can you form a business that just take it to a step before owning it, buy the land, and hire out the builder to do the work? So I thought, well, can that be done? I said, well, not only can it be done, go do it. So that's how that started.
What?
Yeah. I mean, there's a lot of research.
I was gonna say, like, what if I were to buy land? I'd be like, do I call a builder? Do I call like an architect? Like, who do you call like to get this like a property on land?
Yeah, you just start asking people different facets, and then every time you take one step, you learn a little thing. Okay. Yeah, you might take 3 steps forward and then 1 step back. You're like, oh, I thought this was the case, and maybe I made some improper assumptions that proved not to be true. But what you're talking about and like where we're going with this discussion right now, it's almost like we're unfolding why I started the Elite Investor Series. Because I'm like, hold on. Everyone doesn't have to go through their own tribulations to find out this info. They can come to one spot and learn it. And that's why I started the event.
I love that.
Yeah. It's kind of ironic. But to answer your question, like, who do you call? Anyone. So some agents that are really in the know, they have some good info to share. Builders, they have good info to share. Developers, architects, it just depends on, you got to find the right person. And anytime you have a knack. We as humans, we have a knack where it's like, this person really seems to know what they're talking about. Like, let me listen in.
Yeah.
I would always try to, and I still do. When somebody else smarter than me talks, I'm like, I better listen.
Yeah.
Like, let me
right now.
Yeah. No. Yeah. So just consistently doing that, and then through the process of buying 2 new houses here in Tampa, and I would go and I would ask the construction manager all these questions about the build. Then I said, well, can we just do this ourselves? And so we started doing that ourselves. Yeah.
That's cool. But can you just work with essentially like one builder who is like, okay, we'll come up with the whole plan, we'll have the blueprints, and you essentially give me the money? Or is it you need, a builder, then you need like, an engineer, then you need,
Each project varies.
Okay.
So it depends what you're trying to do. I hate the response, it depends, but it really depends.
It's true though.
It depends what you're trying to do. So one of the builder and general contractor kind of in this context are the same. So one of the builders we use, very basic, like they have a list of their models, you choose which model, they have a list of finishes, you choose which finishes, and they do everything. It's go.
Okay.
Yeah. And then on another project, we are engaged with a different builder where it's all custom. That's way more work for us because we're, it's not like you can only choose these 4 finishes. Now it's like you can choose any finish in the world, be mindful of cost, and make sure you don't over or under finish the property, because you want to try to target a certain kind of buyer on the exit.
Right.
Yeah.
Oh, wow.
Yeah.
That's fascinating, because I'm like, oh, it's always been cool to be like, oh, imagine building your own custom thing. But I guess the way you explained it makes it seem quite straightforward. Like, it doesn't seem all that daunting. I mean, not saying it's not daunting and that it isn't, a huge task, but I feel like as an outsider looking at that, you're like, whoa, there's so many hoops to jump through. But I feel like once you kind of understand what you're doing, you can jump in.
I'm always learning. So I think it's dangerous in this industry, period, regardless of your strategy, to think that you know everything.
Right.
So I'm always learning. I never think like, oh, I've got this all figured out. Something I do in real estate investing is I try to be hyper aware of my strengths, but also my weaknesses. I'm not the smartest person in the room. I don't try to put my rooms where I'm going to be the smartest person in the room, but I like to keep them around me. Mm-hmm. And that's only going to make me better and help my team grow. So, it may seem really cool, like the development side. I think it seems to me that a lot of people that aren't in the space portray it, or they perceive it rather, as looking sexier than it really is. And sometimes it's straight brain damage. Like some days you're like, this is hard.
Yeah.
And that's okay. It can be hard and you can do it anyway.
Yeah.
But it's fun to me.
Mm-hmm.
Yeah.
But I think it's important to highlight that because like what you said, I feel like real estate is one of those things people really over glamorize, make it seem really sexy. Same thing with like entrepreneurship. And it's like, yeah, you're seeing the really glamorous, sexy side of it. But, there's a lot of times where you're like, wow, I'm losing so much money. Oh my God, why did I do this to myself? So, having that, balance, and just to know it's not always all rainbows and unicorns when you just jump into the world of real estate.
Yeah, it requires resilience. It'll test you. Yeah, make sure you pass.
Yeah. What is like one of the hardest things that you went through on your like real estate journey? Like, was it a bad lesson, a bad tenant, a bad deal?
No, not like nothing, no crazy tenants. I don't let stuff like that bother me too much right now. We have kind of a weird tenant thing right now, but at the end of the day, I'm at a level where I'm like, mindset wise, this doesn't affect my life in any way. Like I'll be fine. I have food and I have water and we have a roof over our heads. Like if I'm going to let it affect me emotionally, that doesn't help me in any way. So don't.
Yeah.
I would say probably the catalyst was the hardest thing. The catalyst that got me going into real estate investing, because I felt helpless and I hate that feeling. And that's probably what like lit such a huge fire for me to learn more, because I never want to feel that feeling again. That, and then last year there was like, I try to have 1 or 2 Hail Marys out there at all times. Definitely, let's define Hail Mary. Like definitely a riskier investment, a chance for a much higher return. And, like I said, it carries more risk. and that went to zero. I had one last year that went to zero.
Ooh.
So I won't say too much about it because it's a lawsuit now. It wasn't real estate. It was an uncollateralized business loan, not even in this state. But it went to zero, and they declared bankruptcy. And what's valuable, like, I don't like losing money, right?
I mean, who likes losing money?
Nobody likes losing money. But what's cool is I learned so much from that, where now that 150 that I lost will turn into 600 over the next 2 years, just because like the learning that I gained from it. So yeah.
That's a beautiful way to look at it. Most people will be like, oh my God, can you believe how they like screwed me over? And you know,
how did it affect your life?
Right.
Like, do you still have what you need to survive? Mm-hmm. Do you still have your relationships with people you care about?
Yeah.
It'll be all right.
That's such a good way to look at things, because most people will like let that get to them, you know?
Sometimes it gets to me. I mean, you gotta take yourself out of the situation and really look at what you can be grateful for, I think.
Yeah.
It's a practice. That's why they call it a practice.
Yeah. Speaking of, I guess, kind of getting into like the whole acquisition thing, are there like specific ways, like is it like a specific type of loan? Like if someone wanted to start scaling into real estate, would you say by like, oh, it's better to get it for cash, this is a specific type of loan you should get? Like what would you suggest?
It depends on so many factors. There's a few simple ones we could start with. So my first thing that I ask anybody who asks questions like that is I say, what do you want your future life to look like? Right? Do you want to be working 100 hours a week? Then I can tell you what I would do. If you want it to be super passive, that's a whole different thing. Mm-hmm. The other thing too is, are you bankable? Like, do you have a W-2 where you're earning $96,000 a year? Or are you 1099? You don't know when you're making your next commission, right? Mm-hmm. Those are different too. So most people, let's take most people's situation who are asking me that. Most people are bankable and they're making a W-2 income, and they are looking for their first step into exploring this world. I would say house hack. Mm-hmm. And so many people, especially the adults who have done well for themselves and are maybe their later 20s, they're so against it. Because like, I haven't lived with roommates since college, and that's fine. I'm not going to like chastise you for you having your own view. But like we talked about at the beginning of the episode, you're really choosing your own personal temporary freedom in exchange for long-term financial freedom. Short-term comfort, I meant to say, yes. In exchange for long-term financial freedom. And so, I'm not going to shame anyone for that, but if you house hack right, that can be the difference between $50,000 versus $0 a year. Mm-hmm. Okay, well, let's do that for 4 years. Okay, now you have $200,000. With $200,000, now you can go out and put 25% down on an $800,000 fourplex.
Right.
Like, if you hadn't done that, you don't have the fourplex.
Right.
Now that fourplex pays you $1,000 or $2,000 a month. Okay, well you're making 5 figures a year in passive income from your 4-unit just by doing this one thing for 4 years. That's really, I went really deep with that one, but that's what I would say.
But that's good, because it's like you're starting small. That's totally digestible. Obviously, it's like, mm-hmm. you do need to give up your comfort or whatever, but you hold on to that. You can live, and mm-hmm. Then you can pull out your money. You can turn that into a rental after, or sell it, whatever the case is, and then use your money for the next venture.
Yeah.
But how do you go, like, let's say that you're in that like house hacking stage, right? How do you go, okay, I'm still house hacking, but I want to invest into other properties. How do you go about that?
Easiest way, turn your previous primary residence into a rental. So move every 2 years. Mm-hmm. And by moving every 2 years, you take advantage of the capital gains tax exemption. Mm-hmm. None of this is tax advice. If you want tax advice, you need to call your CPA.
Yeah.
You should have a CPA if you're going to be in this business. But, move every 2 years, restart your clock for another capital gains tax exemption, and then you can turn the house that you just moved from into a rental.
Right.
So if you back that strategy up even further, that means the next house you buy, do the numbers now to make sure it does work as a rental. If it doesn't, maybe consider not buying it. Mm-hmm. Yeah.
Okay.
Yeah.
That's good to know, because I'm like, as I'm kind of dabbling into the real estate world, I'm like, I want to know, how do I go about now scaling? Once you get the 1, how do you go 2, 4, 10, how do you go about that? So are there other strategies, like if you wanted to scale faster, other than waiting like the 2 years and then moving?
Yeah, for sure. I mean, that's all that I'm talking about there is somebody who still works a full-time job, not in real estate.
Right.
And they're bankable, so they can keep getting mortgages, and they want to be somewhat passive. That's the type of person that's right for the strategy I just mentioned. Mm-hmm. But ways to scale fast. If you're in the flipping or the wholesaling space, use other people's money. Yeah. Let your friends and family know that you have some experience now that you've developed in real estate investing, and you're willing to borrow money collateralized by a subject property in exchange for a fixed rate of return, right?
So that would be like buying a property for cash or something, essentially collecting.
Yeah, so a flip is a perfect example. So if you get good at analyzing flips, which you need to if you're borrowing other people's money, so the whole idea is like buy it for 200, put 100 into it, sell it for 400. That different, you have 300 all in, then that difference is yours to keep. That's a real basic example, but you understand what I'm saying.
Okay, yeah.
Sorry.
No, go on.
So the point there though is, if let's say that, let's do that example for a second. Let me think of some numbers. So let's say that you have 200K of your own money. How many places could you buy in that scenario with your own money? Really only one to acquire it, then you need another 100 to do the renovations, versus how many places could you do if you're using other people's money just for the acquisition. Now you can do 2 places at the same time, right? Now you can double your profit because you get 200 for the acquisition from a lender. You can do hard money or private money. There's a difference. So 200 from one lender and then 200 from another. You spend 100 of your own in the one project and 100 of your own in the other. Now you're doing 2 at the same time. I should do two at the same time. Yeah.
Ah, smart. And also you mentioned hard money versus private money lender.
Yeah.
Can you just like touch on like what the differences are on those?
Yeah, hard money is an organized institution loaning you money.
Okay.
Private money is an individual that you know and is a result
of you giving me money or something you'd be
not like, giving, but loaning. Yeah.
I'll be taking 100K from you. Thanks so much, James. I appreciate it.
Either way, you're gonna, like, as the borrower or the lender, you're gonna record at closing a lender's title policy and a lien against the property, ideally in first position. So they have priority over all liens on the property.
Okay.
This is the same as you know, any mortgage you get on a property you're buying just as your house, same thing. And so whether it's hard money or private money, that's the common denominator. It's just who is it coming from?
Got it.
Yeah.
Okay.
Yeah.
Okay. And then you had mentioned before when we were talking about like the idea if you're like working a full-time thing, at some point, like, because I know as I'm kind of dabbling into this, if you run into like, obviously you can only take out so many mortgages on your own personal name because at some point you get to a debt to income ratio thing. So how do you, I guess, get around that if you want to continue working full time? And
I was texting with somebody 10 minutes before you arrived about this exact thing.
Okay.
Yeah. So first of all, find a lender who crushes it so that they can advise you. Same thing as like, don't try to be the smartest person in the room all the time. Yes, you should try to grow. Yes, you should try to be smart. But find a lender who's also smart and really good at their game so they can advise you on this. That's common across the board, like attorney, accountant, people who bring you deals, wholesalers, insurance people. You always want to find that to build your team. Real estate's a team sport.
Okay.
So a lender is invaluable when it comes to this. But when you have less than 2, this exact thing I'm about to describe is how I was able to buy 6 rentals in 8 months.
Okay.
So for each rental I acquire, they're going to apply a 25% vacancy to the mortgage, to the rent that's coming in. So let's use some numbers here for a second. Let's say that I buy a cheap rental, and my monthly mortgage payment is $1,000. Okay. Now let's say the rent is $2,000. If they apply a 25% vacancy to $2,000, that becomes $1,500. The inverse way of saying is saying apply a 75%. Apply a 75% filter to the rent for what the resulting amount is.
Okay.
Now subtract your PITI, or your principal, interest, tax, and insurance amount. That's just your normal mortgage payment. Subtract that out. And if that number is positive that you get, so your 75% vacancy applied to the rent, in this case it's $1,500, minus $1,000 leaves us plus $500. If that's the case, it's a wash on your DTI. It doesn't count.
Okay.
So long as you have an active lease with them paying like the first month's rent security deposit. So if you keep filling your units with that, then you can keep doing it again because it's a wash on your DTI. So
they don't count it?
They do count it, but it counts positive. They can't use that $500 as cash flow for your overall, the denominator on your DTI as your income, but it counts as a 0. Yeah.
Oh, that's fascinating. So essentially, if you find a property that is going to net you positive, and like you said, that positive amount, then
Yes.
you kind of can keep going and scaling.
Correct. Now here's the kicker. So if your mortgage is $1,000 and your rent is $1,000, then you're going to be negative 250. So they'll count on your income in that scenario, negative 250. So if that's the case and you keep piling on rental properties, then eventually you're going to hit a point where you can't continue because your DTI is too highly leveraged.
Got it.
Yeah.
That's fascinating because that's always the part that people leave out. Like I always thought, okay, you can only buy so much, then your debt to income is here. But that's like a great way of explaining, like if you find an asset that is going to net you positive, that there's different ways to change it, that it doesn't affect your DTI.
And honestly, I don't know if all lenders can do it like that, but the lender that I used to do my 6 in 8 months did that. So use her.
I'm going to be needing
Yeah.
That's fascinating.
Yeah. So if you back that up even further, you got to plan ahead for that now. So if you're like, hey, I have a plan to close 6 deals in 8 months. I'm on deal number 3. Well, make sure you do the math to make sure deal number 3 can support those numbers so that you don't hit the wall because you didn't do the numbers right. And now it's a negative on your DTI.
Got it.
Yeah.
Okay.
That's the case until you hit 2 years of rental history on your tax returns. And then they use that.
Okay.
Yeah.
Got it. And speaking of deals, what do you classify as a deal? Like what does a deal look like to you? If you want to use like a fictional example or
like a good deal or like a deal that I would do or
like a deal that you would do. Like you're browsing Zillow and you find, a property. How do you determine, hey, this property could be a really good deal?
Depends like kind of what I'm looking for. So let's use development as an example. It's pretty much my goal to close on 1 development acquisition every single quarter.
Okay.
So, 4 per year. We got to back that up. That means I need to be writing on average 1 offer every single week based on our offer, our metrics of offer versus contract accepted versus closed deal. So what I look for is in a development deal, and each strategy is kind of unique, right? In a development deal, what I look for is once I add in the construction cost, I look for, I run 3 scenarios. I run a target sale price scenario. I run a fire sale price scenario, so like a bad situation. And then I run a max sale price scenario, which I don't really use to make a big decision. I use it to see how big the upside could be. Mm-hmm. So the target sale price scenario that I look for is between 12 and 20. Usually it's with permitting, it's really 18. So between 18 and 24 months time frame, can I make around a 25% total return on my money invested in that time? So it's not annualized because if it takes 24 months, then that's 2 years. So 25% total return or better. That's the minimum that I would do. If it was 16%, I wouldn't do it. I would say, well, we got to offer a low price on the acquisition because that's the one thing we can control right now. And then the fire sale scenario has to be better than 0. So like the market goes down a lot, our construction costs go up a lot. If we do this project and our return is 0.0 on a bad day, I'll still do that project. We just built a house for free, but we didn't lose money. Yeah.
Wow.
Yeah. I mean, but like you want to prevent it from being negative, right? In a fire sale scenario, if it's negative, you just built a house and you paid somebody else to close on the final project.
Yeah, that's worse.
And the max sale price, like anywhere between 50% plus on our money invested. So.
Okay.
Yeah.
Yeah. And that's for development. What if it was like, I mean, I know you don't do rental units anymore, but I guess would you be able to give like a rental example just because I feel most people listening, that might be the first avenue in which they... Yeah,
I'll use like commercial multifamily as an example. So I like to see an average annualized return of high teens or better, maybe 17% to 25%. 25% would be pretty high.
Okay.
I like to take advantage of bonus depreciation for my, my tax scenario. Mm-hmm. And then... let's see. I like in some of these commercial deals, I like to see a preferred return of between 6 and 9%.
Okay.
And then, actually, I think that's pretty much it. Those are the easy metrics. Oh, I guess hold duration. So it's not really a metric I make a big decision on, yes or no, but I like to diversify basically everything in real estate, including the hold times. For example, we're looking at an opportunity zone project that I might be investing in. There's some connections I have in Tampa that would be a 10-year hold versus the normal, like more 5-year hold.
So that's not a no. It's just be aware of, hey, it's a decade, right?
Right.
Like, you're not going to see that money again until you're in your 40s. So
Yeah. The recent kind of, I guess,
like news.
Yeah, news about like BlackRock
Yeah.
and Bill Gates buying like all of these big, huge, multi-billion-dollar businesses buying a lot of like residential real estate. Like, what do you think of that?
I think it's risky to put restrictions on businesses owning real estate. So I'm not a fan. Like, even if it means more competition for me, this is a capitalistic society.
Right.
That's the environment we live in.
Yeah.
I'm against it. I'm against legislation preventing corporations from buying real estate.
Yeah.
Yeah.
So you're just like, I just got to be better and swoop them in before they do.
I mean, I don't think they're buying the same assets that I am if they're buying single family homes or whatever. But think about it. If you grow a company, if you took all the risk to grow a company and you trained a bunch of acquisition people to do a really good job at acquiring properties at a discount that'll cash flow at a great price, and the mission of your company is to optimize that strategy and produce revenue, like, why do other people feel the need to encumber that with rules? Like, just because of the size of their corporation or how well they're doing with it?
Yeah.
That seems silly to me. We're not restricting like Amazon from delivering packages to your house. Everyone loves that because it provides a service.
Right.
If this service is them buying up real estate because a lot of people choose to not get a mortgage right now because they think it's a risky time to buy, and so all those people are entering the rental market and they're paying for cash for it because you didn't want to get your mortgage. Now you're forced to rent from them. Then you are living with the consequences of your own decision, right? At the end of the day. Yeah. I'm not trying to sound rude towards people who don't want to buy right now. I understand that standpoint. Don't get into something you can't afford.
Right.
But there are other ways besides renting.
Right.
So
yeah.
That's my opinion on it.
Okay. Yeah, noted. I remembered the thought that I had from before when you were talking about the amount of return that you look for. Is there like a specific calculator or a calculation that you do that you can just, is it something that you know? Do you Google like
There's many. Okay. There's many. Yeah. I have my own tool that I've kind of like merged different spreadsheets from different people that I knew into my development tool that I use. It's just like my own proprietary thing. In fact, I think if most people looked at it, they'd be like, oh, this is hard to understand.
Yeah.
But it works for me.
Yeah.
So
yeah, because I've seen different ones and they kind of give you different tidbits of information.
Yeah.
So I'm like, which one is good? Which one is okay? And like, it's sometimes as someone new, it's hard to determine which one is going to give me the answer that I want or is doing the calculation properly.
Yeah, put most simply, here's the fundamental calculation that I'm trying to do on development. And this sounds so brainless, but it's I think important to understand this fundamental. You need to create an equation where 3 + 2 = 9. Okay. 3 + 2 can't equal 9. That's what's left over. That's yours.
Okay.
And if you don't do that, if you created an equation where 3 + 2 = 5, you built the house for free. You built the property for free. So don't do that. There's a lot of other stuff, right? We could do like 3 was the land and 2 was it's probably inverse, by the way. It's probably 2 is the land and 3 was the build and 1 was like holding costs and permitting and upgrades and all that stuff. So there's a lot of detail you can go into that. But I think it demonstrates the principle for what you're trying to do.
Got it.
And then obviously like do it ethically. Don't build something that's going to fall apart in 2 years. And, don't go like City of Tampa is really big about their trees. And so don't go like illegally cutting down all the trees just to get around that rule because that's not good for your neighbors. It's not good for the environment. It's not good for the city. So obviously the assumption is like do it all the right way by people, but that's the fundamental calculation.
Okay.
Yeah.
And you said you do that for developmental, but is it the same whether it's buying commercial real estate, residential? Like it's
the art of adding value is important to understand in real estate because if you buy an asset at market price, you're already kind of behind.
Yeah.
So you need to find a way to buy it before it's at its best and add value to it for less than it costs to generate that ultimate value at the end.
Got it.
Yeah.
Okay. And how do you are there specific sites that you use to like find real estate? Like I know I'm like a big like Redfin, Zillow, Realtor.
Yeah, that's fine. It depends what you want. Like residential versus commercial is different. Off market versus on market is different.
If you want to find the best deals and you have cash and you are willing to do a distressed asset, then get off market. I talk to a lot of people that are like, I do off market only. I'm not even going to look at on market. The last 3 deals we've done for development were on market. Mm-hmm. So like to pass up literally the best marketing location for real estate ever, which is on the market on MLS, because you're proud and you only want to do off market and you're leaving all the other on market stuff on the table. To me, that feels a little silly, but it's not for me to say. That's your business, not mine. We look at the market and off market. For off market stuff, you want to build relationships locally. Another reason why I started this meetup. Mm-hmm. So yeah.
Nice. And I guess talking about the market, as you know, like the past year has been like such a slowdown for, I guess, the average buyer, right? Because interest rates were high.
Yeah.
How do you navigate that as like an investor? Do interest rates like not
they do
bother you?
Oh no. You need to be keenly, I think you need to be keenly aware of what the cost of money is, which is your interest rate. If you discard that, then you're going to be caught negatively in a really bad way. And so I think it's definitely something to take into account. It's funny, a year ago we did predictions on our podcast for the 2023 market, and mine were so wrong. So like I don't want to do predictions for 2024. I didn't think we'd be seeing an 8% interest rate at some point this year.
Yeah.
And we did. But I have my thoughts for what 2024 will hold. I believe in my approach so much that I'm personally executing it with buying my own properties. But yeah, everybody has their own kind of approach to things.
Yeah. But are there ways to like navigate that when it's like, hey, I'm in a position, I want to buy real estate, but is it foolish of me to do it when an interest rate is so high? Or are there ways that you would recommend to still purchase without having to, are there ways to get around that essentially?
Yeah. Like it's not my place to make decisions for others, but I think the advice that I would give to somebody is don't buy anything you cannot afford. And then have different contingency plans if it doesn't go the exact way that you think it'll go. Mm-hmm. I'll give you an example. If you make 6 figures, you make $100,000 a year, and you have this dream of owning this like $800,000 4-bed, 3-bath, nice new construction house, you might have to put that dream on hold because that house is about to cost almost your entire paycheck, right? Yeah. That house is going to cost somewhere around $6,000 right now with the way the mortgage payment is. Mm-hmm. With normal living expenses, you probably cannot afford that house. That's okay. That may occur in 2 years or 4 years once you do this other thing. So you might have to manage your own expectation and bring that down a little bit so that instead of the $800,000 house, maybe this year you buy the $400,000 house. Hey, not a loss. That's actually a great strategy. Later, that could be a rental. And then you built up enough reserves and savings and other investments. And now this is a passive option that you can depart from and go into that $800,000 property. Mm-hmm. But a lot of people, especially like I feel like in our country, a lot of people are pretty short-sighted and impatient. I mean, I'm impatient too, but I think in a different way. And they want what they think they deserve now. Mm-hmm. Well, you can get, instead of that, you can get what you earn later.
Right.
Yeah.
Oh, that's a good way to look at it.
Yeah.
Yeah.
Quote it.
I'm going to quote that. I'm going to use that as like what we do for the podcast. You heard it here from James.
That's good.
One other question, I guess, would you recommend getting your real estate license if you want to be like passively investing in real estate? Like I'm saying not like a super active, like but you're from time to time you want to purchase things. Maybe it'll change, but.
What do you want your future life to look like? No, I'm just kidding. So if you do the math, if you do about 1 deal a year, at least for yourself, if you're like, I'm very confident I'll do 1 deal a year for myself, I would say go for it. Mm-hmm. Yeah. If you're young and like you want to explore that, I would say go for it. Now it gets even better if you do more than 1 deal a year.
Right.
Maybe you have friends. You can also set up just like totally just a referral business where you connect different people who want to buy. You don't have to represent them, but you connect them with your favorite agents. And then now you're getting passive income that way.
Yeah.
I mean, that could be 5-figure. You could do $10,000 plus a year doing just that.
Yeah.
So yeah, it's not a bad idea, but it's like, I think a lot of people that work full time, I've seen it happen where they think, oh, I can just do this and it'll just come easier to me. No, there's not like some apple seed got planted in your head of like knowledge
that automatically you're good at analyzing properties and doing great investments. No, that's not the case.
Yeah, you just got to sit there, learn, absorb from peers and do the thing, I guess.
You got to do the thing.
Do the thing.
Do the thing. Yes. Going back a little bit, I don't think I finished my, like kind of talking about the market right now.
Yeah.
I think here's kind of what my overall approach is at this moment. We have some very shocked buyers that are in the market who've pulled themselves out of the market because they're like, I can't believe interest rates are at whatever, are at 7% or 8%. I think the writing, and keep in mind, by the way, the sellers out there in the market have somewhere in the 3s, maybe lower, 3% interest rate on their house.
Mm-hmm.
So 8%, the thought of them selling and then going back into the market to buy at 7% or 8% is kind of like not great for them. So a lot of the sellers are holding onto their properties, right?
Right, of course.
So all these buyers that came out of the market, when the interest rate drops to 6 or 5.5, think about it. The sellers, they still don't love the 5.5. They love their 3. In my opinion, that's not enough incentive for a huge influx of sellers to just flourish. A huge influx of sellers to surge back into the market. But it is enough to remove some of that shock for buyers to come back into the market.
Mm-hmm.
And so when we have supply, because the sellers aren't flushing back into the market, supply is going to remain somewhat constant, maybe a little bit up, but we're going to have so many buyers come back into the market this year because they just exited in the last half of 2023. That's why I think, for me, I think prices are going to go up in 2024. I believe that so much that I'm personally buying right now, like in 3 weeks, I'm buying a new house. And I think between now and maybe February to April, somewhere in that time period, between now and let's call it April, I think that will be an excellent time to buy. Here's why. If you buy the house now that 9 months ago was $900,000, just a single family house, new construction, let's say, it was $900,000. Now you can get it for, let's say, $800,000. Well, that house in 8 months might be worth $900,000, $950,000. And I got it at the 8% interest rate, but now I can refinance that down to like a 5.5. But I didn't pay $900,000, I paid $800,000. So I'm refinancing my original principal, which is the move.
Right.
Yeah.
And then you save big time because you got it low, and now you're essentially going to take advantage when the interest rates drop.
Yeah, but don't do that if you can't afford it. Like I'm buying knowing that if the interest rates balloon up to 12%, that's fine.
Mm-hmm.
I'm okay.
Yeah.
Yeah, and I can hold on for 2 years, 5 years, whatever the case. I have backup plans.
Mm-hmm.
Don't do that if you're not ready to weather any kind of storm or if you can't afford the normal mortgage payment.
Yeah.
But that's what I think.
Do you have anything for me before we wrap up?
What's your vision for this podcast? Like where are you going to take it?
Ooh.
What does success look like?
Oh, that's a good question. That's a good question. I think ideally being able to make a good chunk of money off of the podcast. Like if we're making, $10,000 a month off the podcast would be cool.
Okay. So you want to monetize it?
Yeah, definitely monetize it. But also just getting to meet really awesome individuals. Like you're our 4th guest so far. Every single person we've talked to so far has been like phenomenal. So
cool. All right. Hopefully
you're like adding, it's like every person, it's like we go up and up and up. So it's cool.
That's great. Yeah.
No, so I mean like even just, selfishly adding people to my network that like otherwise it might have been kind of challenging to get them into my network, but then also getting to have a conversation and learn about their life and, just it's a ton of like invaluable information. So yeah, I would say being able to monetize it, just being able to meet people I admire and being able to learn those lessons and then apply those too, because I'm building my own stuff. So being able to take advantage in that way too, I think would be cool.
Yeah.
That's what I want.
Cool. I think monetizing is a great idea.
Yeah.
Can I challenge you on that a little bit?
Yeah, go for it.
When it gets hard, and I'm not like in the podcast, we have our own podcast. It's called Green Squad Chats. Our vision was never to monetize it. So I would say take this with a grain of salt because I'm not operating in the same space, but I've learned this from my own business stuff. And it's just a thought, right? If it helps, great. If you don't like it, toss it. When it gets hard, worry less about the monetization and try to deliver real value.
Yeah.
Yeah.
Yeah. And that's what my biggest, because I'm like, I don't even know if and at what point it would get monetized, but just enjoying the conversations and just the tremendous value add has been like by far the best part. Like I'll go back, I'll look at the clips, I'll like watch back, and I'm like, my God, it's almost better to listen to it a second time, even though I was like there in the moment. So, but I like that. I think adding value is always that's the best thing to ever do and to help other people. So
absolutely.
Yeah.
Yeah.
But thank you so much, James.
Yeah, good stuff. It's been great.
I really appreciate you like doing this whole deep dive into all things real estate.
I feel like I blacked out. I just like,
yeah. I mean, we touched on like so many different topics. I'm sure that we could do a whole other episode of just diving into like more things. I'm sure there's 1,000 other things, but I mean, you really gave us like a ton of really great information in just this time. So
good. I'm glad it was valuable for you.
Yeah, I appreciate it. Thank you so much.
I'm very humbled. Yeah, thank you.
Thank you.
Cool.